This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello, everyone. Welcome back to a brand new episode of the Smart Property Investment Show. I recently had the pleasure of sitting down with the Head of Investment Strategy and Chief Economist at AMP, Shane Oliver, and we talked all things the economy, rate rises, and what it all means for the property market. It is well worth a listen. I hope you enjoy it. Shane, welcome to the show. Thank you so much for taking the time.
Thank you, Grace, and it's my pleasure.
Shane, I'm coming to you at a pretty interesting point in time. The Reserve Bank of Australia obviously lifted rates last week, first Tuesday in May, which came as a shock, surprise to some people, not so much to others. What are your personal thoughts on last week's lift and whether or not it needed to occur?
Well, I was of the view that they should have paused for a little bit longer. I understand the desire and the importance of getting inflation down. I think that's critical. The debate is about how far you need to raise interest rates by and how you do it. And I worry that by jacking up interest rates so rapidly, which we have seen since May of last year, that we run the risk of ignoring the lagged impact of interest rate hikes, and therefore you have this risk that you tip the economy into recession. So I thought it made more sense to pause for a little bit longer. I mean, continue with the tough language. If need be, go again. But I think waiting 1 month didn't really provide us with enough new information to justify starting the hikes up again. In the past, we'd go on a pause and it would be 3 months before the next one. And that's probably a better window to gauge the impact of past hikes. I know, some areas of the economy are still doing very well. For example, restaurant sales, you go to a cafe and lots of people there. But by the same token, we're still benefiting, I guess, to some degree from the reopening trade, revenge spending, and so on. At some point, that will run its course. And in the meantime, you're going to end up with about a third of households experiencing a lot of pain as a result of these rate hikes. And that I think that, the more we keep raising interest rates, the greater the risk we plunge the economy into recession.
What are the indicators then that you were looking at in the lead up to the most recent decision to go, okay, no, like it is at that point where I don't think we actually need to do it anymore? And I guess what indicators is the RBA looking at that counters that view?
Well, to some degree, there's an overlap there. The RBA a month or so ago nominated they would be looking at, obviously, inflation, what's going on in the global economy, the household sector in terms of household spending, and employment, and I guess business surveys or business conditions. So if you think about the indicators that came out in the last month, we got some strong jobs numbers, unemployment still at 3.5%. But we got some lower inflation numbers, and there's ongoing uncertainty about the global economy. We hadn't really got a decent update on retail sales. That only came the day after the meeting, and I thought it was on the soft side anyway. So, my take on those things suggested, well, it's too early to come off the pause, wait a little bit longer. Now, the Reserve Bank obviously took the view, well, yes, inflation has come down, but it's still high at 7% on the quarterly number or 6.3% on the monthly number. They also worried there's increased risk of wages growth above that, which would be sustainable. And I guess they're taking their lead there from the removal of the state public sector wage caps in New South Wales and Victoria, claims for a 7% increase in the minimum wage, and still tight labour market. And they also, interestingly, nominated that they were looking at asset prices, and in particular they singled out the Australian dollar and house prices. In terms of the Aussie dollar, it's down a little bit from its high point in February. I didn't think there was enough in that to get too concerned. It's in the range it's been in for the last couple of years. So that surprised me a little bit. Now, the other one is house prices, and obviously the Reserve Bank has the housing market in its sights. To some degree, it wants slower house prices or lower house prices because that means a negative wealth effect. That as house prices fall, people feel poorer and they spend less, and that helps the Reserve Bank achieve its aim of getting lower spending and lower inflation. And of course, in the last few months, house prices have picked up. Whether you look at the CoreLogic data, the PropTrack data, the difference of degrees. But it looks like property prices have started to pick back up again, given the increase in immigration, the very tight property market generally, and I think to some degree bargain hunters creeping in. So the Reserve Bank started to get concerned at that and actually nominated that as a factor, whereas I thought, well, that's probably a little bit premature. A couple of months don't necessarily prove anything in terms of house prices, but nevertheless, that's what they looked at. So there's always going to be differences of degree because economists have differences of opinion on these things. Some say the RBA is going too far and done too much. Others say, well, they've got a lot further to go. And obviously, to some degree, the Reserve Bank reflects that range of opinion, but they've come down on the side that you need to do more. But it is interesting to note that they are concerned about wages growth being too strong, and they are concerned about the property market turning up too quickly.
And we will go into the property market in a little bit more detail later. But one word that you did bring up, Shane, that I will have to get you to elaborate on is that recession word, the big R. How far do you think, the most recent rate rise plus the potential for more down the track could actually lead to us entering that territory?
Well, right now, I'd say the risk is 55% that we avoid it, that we have a soft landing. We're going to get a slowdown. And 45% chance we go into recession. So it's getting to be a close call. And you could argue similar things in relation to the US and Europe. Obviously, as you raise interest rates, it takes money away from people. In technical terms, economists get all excited by yield curves. Yield curves invert. That's where long-term interest rates fall below short-term interest rates, which is a disincentive to borrow and invest, because if your short-term rate's up here and your long-term expected return is down here, then you don't invest. So they're inverting. It's been a less reliable guide in Australia. So that risk is certainly there. It's always hard to gauge precisely what is the level, and I am conscious of my experience many, many years ago now, before most listeners put into these things in the late 80s, early 90s, that the RBA, totally different environment back then, lower household debt, generally higher interest rate structure because we were at the tail end of the high inflation 1970s, 1980s period. Anyway, they raised the cash rate from just over 10% to around 18%. That took mortgage rates up to 17%. And then knocked the economy off the edge. But through the period they were raising interest rates, it seemed like the economy was very resilient. Unemployment kept falling. Paul Keating said, and he was the then treasurer, said something to the effect that the economy is like very effervescent champagne with the bubbles overflowing the sides of the champagne glass. The economy is so strong. And then, of course, at some point the economy broke. And we ended up with the recession that Paul Keating said we had to have in the early 1990s. But it took a while before you got to that point. And that's the problem here, that if you don't wait to see the impact of your rate hikes, then you'll keep going and keep going and keep going. And then finally you find you've gone too far. And so that's why that risk of recession is there. And that has blowback effects to the wider economy as well. And it's relevant to the property outlook. Because right now you've got rising interest rates, but you've got low unemployment. And to some degree, that's giving some buyers confidence. But if you move into a world where unemployment rises, then it might reduce some of that confidence. So that's why these things matter. It's not just interest rates. It's not just immigration, but also unemployment is very important to the outlook. But as I say, my base case is we have a slowdown in growth, that we're near the top in interest rates, but that risk is certainly there.
You sort of answered my next question there, Shane, which was around, in your experience, have you seen a situation similar to this where all the indicators are kind of heading in that way? And would you, can you take many lessons from that time period, or are we still in a little bit of uncharted territory here with the actual current situation? And the fact even I think that it did kind of come about, well, was exacerbated by the pandemic and what happened in early 2020.
Yeah. There's this old saying that I think Mark Twain is said to have said, but when you go through what he wrote, there's no evidence he said it, but there's variations on it. It's basically history doesn't repeat, but it rhymes. So each episode is different. You've got the pandemic here, which has thrown things out of kilter, but there are some parallels to the late 80s. So it's a very different cycle to what we had over the last 30 years. The interest rate hikes that started in 1994 and later in the 90s and so on and so forth, up until the post-GFC interest rate hikes. Those hikes were generally fairly modest in scale. It didn't take long before things slowed down again and cooled down and we're back to low inflation. This time around, like back in the late 1980s, we've got more inflation. The Reserve Bank has increased interest rates, not quite as aggressively as back then, but it's far more aggressive than anything we've seen in the last 30 years. So that's why, it is worth looking at that period. And we did go through roughly a 2-year period where rates went higher and higher and unemployment fell. And of course, back then we didn't have the announcement effect because the RBA didn't put out constant statements on this stuff. You can survive in a world where the RBA doesn't talk every single day.
You sure?
I'm pretty sure. The RBA review that came out 3 weeks ago said otherwise, that they need to talk more. We've got to have press conferences. We've got to have board members speaking. They've got to put out more material. I struggle to keep up with all the material they put out now.
That's a relief for me to hear, Shane, that you feel the same way about the barrage of information coming from them.
It's overload. 70 pages last Friday, speeches through the course of the week, post-meeting statements. If you throw in there board members out there talking all the time, and sometimes they're going to disagree with what the RBA view is, that's really going to overload people and confuse people. So I think some of the recommendations are a bit over the top. And economics is a very inexact science. If you call it a science, some would say it's an art. Throwing more economists at it with lots more communications and lots more analysis won't necessarily lead to a better outcome. So the reviews seem to say, well, Canada and New Zealand, that's what they do. So maybe Canada and the UK, we should do the same thing. But I think that's a bit misplaced. And those central banks that have done what the review is proposing haven't actually achieved better outcomes in Australia. In some cases, they've been worse. So I struggle a little bit with the view that they should move to an approach where we got information overload, which is what they're proposing. But anyway, I've digressed here. The point was that back then you didn't have an announcement effect, so they would raise interest rates, but they didn't tell anyone, which wasn't such a good thing. That was the other extreme. So they had to raise rates a lot more, and also household debt relative to people's incomes was about 1/3 of what it is today. So a 1% rate hike back then would be equivalent to about a 0.3 percentage point rate hike today, or a 30 basis point rate hike today. So you can make an argument that today's 6% mortgage rates are equivalent to the 17% mortgage rates we had back then, given the much higher level of household debt. But the one key parallel was that they kept raising interest rates because the job market was strong, inflation was too high. They're backward-looking indicators, and ultimately they went too far. And so that is, I think, a key lesson from that period. That, you want to get inflation down, but you don't want to do it so hard that you knock the economy into a deep recession. And that was a deep recession because we went from 6% unemployment to over 11%, and it took a long time to get it back down.
Some very good food for thought there. Plenty more to unpack just after the break. See you on the other side.
This year might just be the right year to invest in property. But before you jump in, do you have a low-rate investment loan pre-approved? It might be the right time to invest, but the wrong loan could dent your prospects for achieving the maximum return. Are you armed with the best finance at the sharpest rate? Find out with Finny. Call us now on 1300 002 023 and find out what you could save. Or visit our website, finny.com.au to book an appointment.
Welcome back to this very special conversation. We are talking with the Head of Investment Strategy and Chief Economist over at AMP, Shane Oliver. Shane, it's been so insightful to talk to you already. We've still got a couple of segments to go. Before the break, you were talking about, the RBA trying so hard to curb inflation back to that 2 to 3% range. There's been a bit of talk lately, though, about the relevance of that. In 2023, that was set a long while ago now. In the scheme of things, there's obviously been a lot of world changes since then. What are your thoughts on the RBA, still trying so hard to pull things back into that 2% to 3% range? Or is it actually achievable at this point in time?
Well, it should be. The problem is in adopting some other level that you may destroy confidence in the low inflation framework. So over the last 20-odd years, I can remember several occasions where economists and other people have argued we should change the target. If you look at the run-up to the GFC, so this was a period not in the GFC, but in that strong commodity price period around 06, 07, 08, economists were arguing, some economists were saying at the time, well, 2 to 3% inflation is too low. We're in a more inflation-prone world. We better revise the target up. Unfortunately, the Reserve Bank resisted it. Then in the post-GFC era, where we had inflation below target, many economists said, well, maybe we should revise the target down. And the problem with those sorts of arguments is that it's a bit like changing the goalposts, that if you keep changing it around depending on where inflation is, then you will lose credibility in the target. I don't think the world's changed that much from the 70s. It was an inflation-prone era. The problem then was that they let too much inflation creep into the system, and then they found they couldn't get it back down again. In an ideal world, you shouldn't have any inflation. It should be close to zero. Some prices will go up and others will go down, but on average, it should be zero. But the problem with that is that when you try and measure it, it's hard to get a handle on that because there's always quality improvement. Like a car you buy today might cost the same as the one you bought a few years ago, but the quality of it's substantially improved. And so the ABS has to try and allow for that. But they tend to under-allow for it. And therefore, whatever way they measure it, you're always going to end up with some inflation. Even if real inflation was zero, you're always going to end up with some inflation. And by the same token, they don't want to set inflation at zero and then find, well, every time you have a downturn, you might tip over into deflation because deflation is a pretty bad thing as well. So at the time, the policymakers 30 years ago settled on 2 to 3% for Australia because it was low enough, but it allows for that quality adjustment issue in measuring price changes, but it also provides a bit of flexibility either side of the target. So I'd be inclined to say that it should stay where it is. As soon as we adopted that target in the 1990s, Australia's economic performance improved dramatically compared to what had been the case before that. More stable economic conditions, less volatile interest rates, and so on. So I think it makes sense to keep it at that lower level. And if anyone thinks that a little bit of inflation is good, just go back to the experience in America and Australia from the late 1960s into the 70s. That every time they allowed a little bit of inflation, they got more than that. And wages went up to compensate for it. And then companies would have to pass the wage rises on. And before you know it, we ended up with very high inflation at the same time as very high unemployment. So I think in the interest of avoiding locking in very high inflation and very high unemployment, a better approach is to try and get it back. But the Reserve Bank is right to say, well, we don't have to get it back all in one go. We can, do it over a few years, which is what they're doing now. So the good news is, despite my criticising them for raising interest rates last week and maybe going too far, that they haven't been as aggressive as other central banks that have interest rates well above Australia. Like the US is now in a range of 5 to 5.25. Canada is 4.5. I think the UK is around 5-ish. New Zealand's above 5. So, many countries actually above Australia now.
And I know that, the RBA has been watching what those countries are doing as part of their measurement of what's going on. Do you think, even though it was a bit of a surprise rate hike in May, that we will see any more towards the end of this rate hike period? I know we're crystal ball gazing at this point, but there has been talk that we probably have reached the peak now of that inflation curve. It is starting to probably drop from that 7% point. But, what are your thoughts on what could come next?
Well, my crystal ball has been a bit off lately, and the RBA has raised rates a lot more than I would have thought appropriate. I mean, maybe it's right, and then we'll end up with a sharper downturn than we need. And I could look back and say, well, I was right, told you so. But who knows? For the time being, I've been wrong. Rates have gone higher than I thought they would or should. And so therefore, I'd have to say there's still a high risk we might go a little bit higher. As far as I could tell, the consensus is that we are at the peak, 3.85%. That's our view too. But obviously, the Reserve Bank is still sounding tough, still with a bias to raise interest rates further. And so therefore you can't rule that out there. And there are credible economists out there who I respect, talking about the cash rate having to get above 4%. So I can't rule that out. So that risk is still there. If I were a home borrower thinking about right now, I would, notwithstanding what the bank will lend you in terms of serviceability and so on, serviceability tests, I'd still allow for another 1 or 2 hikes just to be safe. From here, in terms of the amount you ultimately borrow, in terms of thinking around house prices. But my base case is that we're at the top. yes, there's a risk on the upside. By year end, I think we'll probably start to see rate cuts, or if not, then early next year. And that will be because the economy will start to slow, inflation will fall faster than the RBA's assuming, and therefore they'll do an about face in terms of interest rates. We put together a little indicator of inflation. It's been falling in the US since the middle of last year, and guess what? US inflation's been falling since then. In fact, it was a little bit earlier than that, so it's been falling for some time now. It still points down for US inflation. It's a similar story for Australia. It actually peaked around the December quarter, and it's now continuing to fall. So those little indicators, which are based on things like goods prices, supply bottlenecks, and so on, state of the labour market, that they are rolling over and pointing to lower inflation ahead.
Given all those factors, and if for argument's sake we're not at that point where households, are severely impacted by severely impacted by the rate hikes to date, when do you think we'll be at that point? And does it even require any more rate hikes for that point to be hit? Or, is it something that we are going to see that lag come through from?
There's a lag there. Rough estimates from economists say 6 to 12 months. So we are now starting to see the impact of the rate hikes that occurred May, or that first 6 rate hikes. They're starting to impact, but the last 6 are still feeding their way through. Obviously, if you're on a variable rate loan, I think it takes 2 to 3 months from the RBA making an announcement to you actually paying a bigger amount in your account. If you're on a fixed rate loan, and the issue here was that 40% of bank lending at the start of the hikes was in fixed rate. And so those people are all protected, but they're now starting to roll off. There's a big hump, or a cliff, if you want to call it, in fixed rate loans that mature this quarter and next quarter. And so there's a lot of people out there on fixed rates have been protected so far, locked in at 2% or thereabouts, will now start to be paying 5 or 6%. And that can mean a lot of extra payment. If you've got a $600,000 mortgage, you'd be up for something like, it's hard to be precise, but it could be extra $14,000 per year in interest payments. So that will start to show up. There's also the way it affects spending decisions, that people see the rates go up and then they sort of say, I'm going to have a bit less income, but they've already locked in to go on a holiday and already had a plan to buy a new car and have the savings set aside for that. So it takes a while for people to adjust their spending as well. But I think the bulk of the impact will start to show up through the second half of this year, particularly in the December quarter, and then in the early part of next year.
Is that a concern for you? Is it something that's sort of being, for want of a better word, being taken seriously enough by the RBA with what they've done? I know we've sort of talked that they probably shouldn't have even lifted the rate the most recent time, but, are we headed for quite a serious economic impact down the track?
That's the big risk here, this recession risk, or even if it's not that, it's still going to feel pretty rough. It does, again, it reminds me of the late 80s. I remember back in 89 forecasting a recession and getting criticised for being too pessimistic. I remember our fixed interest team then saying, there's no sign of recession here. Look out there, everyone's in the shops and restaurants and so on. And then suddenly it hit in 1990. It doesn't quite come when you expect, but it does come. So that is, the big risk here. The other factor is that, population growth this financial year will be around 2% or more. I mean, the budget will provide an update on that, but we're looking at an extra 400,000 immigrants this year. The norm is about 240,000. So the doors have been opened and people have rushed in. A lot of them are students, but whatever it is, it's a big increase in population, fastest increase in population since 2008 that we will see. So it sort of masks, it may be the case that we avoid a technical recession where GDP goes backwards, but it could still be what economists call a per capita recession, where GDP per person goes backwards because of the surge in population and a slowdown in GDP at the same time. So living standards, the average person would say, well, I felt my living standards go backwards, even though the measured economy still goes forward because you've got more people in it. So that risk is there and it can cause a lot of pain. And then I know there's commentators out there, and in fact, the Victorian Premier recently saying that he's not sure that raising interest rates will actually lower inflation. but it will cause a lot of pain. I kind of think, well, he's half right there. I think it will cause a lot of pain, but it's that pain which will lower inflation. So if there is a rising risk of recession, that is where people spend less, then that will certainly knock inflation lower. So I don't think we need to worry that, we'll end up with a recession and high inflation. I think that's unlikely. History tells us that once you go into a recession, people spend less and inflation goes down.
And I guess some of that as well has come through from the notoriously cheap finance that we've been seeing over the last couple of years, and those people now that are coming off those fixed rates. It's a conversation that we're having all the time around, obviously those variable rates getting higher and higher, and the fixed rate cliff and all of that. Beyond that suffering, short term, where does cheap finance, what are the long-term consequences of periods where, finance does become so cheap? Can we expect like a hangover in, 5-10 years time on the property market, on other marketplaces because of what we have gone through in the last 3 years?
Yeah, that's a good question. It was sort of at the background of some discussions around the pandemic period. So we pumped a lot of cash into the economy, JobKeeper being the big part of that. And we also took interest rates to zero or very near it. And we pumped cash in via quantitative easing, which found its way into the economy because via government spending, if you like. The hangover looks to be upon us already. I mean, it's in the form of high inflation. Mm-hmm. And people who took on debt then are experiencing that perhaps more acutely than others because not only have they got high inflation, they've got rising interest rates. So I guess there was an assumption on the part of many that, well, we've been through a long period where interest rates trended down, kept going lower and lower and lower. The RBA was even cutting interest rates in 2019 ahead of the pandemic and then had to cut them even further. And so people naturally assumed, well, interest rates will stay here down at these levels a lot longer, therefore I can borrow up to get into the property market and pay other Australians top dollar. Property prices rose 30% coming out of the pandemic. And then, of course, the misplaced guidance from the Reserve Bank governor that rates wouldn't go up till 2024 at the earliest based on their forecast, that just added to that. So you ended up with this hangover. You pump money into the economy. All this is clear in hindsight, by the way. It's not as clear back then, but it was a bit of a fear back then. You pump all this money back in, sooner or later you might get inflation. We've now got that inflation, but it's also meant higher interest rates. I think there's a broader issue that if we've come into a more inflation-prone world now because of deglobalization, so we want to make more things in Australia because we can't rely on supply chains from other countries. That adds to costs because it's going to cost more to make things here. More spending on defence, bigger government. That's going to add to inflation because government sector is less productive than the private sector. And if that's the case, then maybe the interest rate structure is going to be higher than it used to be, and that's going to be a bit of a constraint on future capital price growth for property compared to what we've become used to. You don't want to push these arguments too far because you sound like a Pollyanna or something. You sound too negative. But there is that risk. If you think about the last 30 years, interest rates came down lower and lower and lower. That enabled asset prices to go up relative to people's incomes, house prices to rise relative to people's incomes because lower interest rates meant you can borrow more, push up house prices relative to income. Maybe that has to reverse to some degree or puts more of a brake on capital price growth in the real estate sector. But the same argument might also apply to other asset classes like shares, for example, or infrastructure. You just got less upside return potential if we're now into a high interest rate world. I wouldn't get too depressed. I mean, long term tells me property will still deliver good returns on a long term basis through. You just might have to wait a little bit longer. That if we've gone from the period of adjustment from high rates to low rates, if that's over, we're now settling into a period of somewhat higher rates than in the past, then that's going to be a bit of a constraint on price growth. So therefore, the capital growth may not come as quickly as it has in the past. Now, of course, working against all of this is we're not building enough properties. We're not releasing land quickly enough. We all want to live in big capital cities. We're pumping immigrants. All of those things are positive, offsetting some of that negative interest rate considerations I referred to. So that it all makes analysing the property market a bit difficult at present. But I think the bottom line is if we are in a higher interest rate world than we were used to, then it's going to be a bit of a break on house price growth relative to people's incomes.
Mm-hmm. We're going to keep unpacking this. I've got a couple more questions left for Shane. I'll see you on the other side of this break. Welcome back to this very special conversation. We are chatting with the Head of Investment Strategy and Chief Economist at AMP, Shane Oliver, talking all around the property market now. And obviously, Shane, you're the Head of Investment Strategy. You know a thing or two about where people should be looking and what's going on. And as you said before the break, there's long-term, there's still a good outlook for property, as there is for many other asset classes across the country. Sticking to the property theme, because we are all about property here, I'm curious where you see in the short term the property market heading, because we have, as you mentioned before, we've seen a pickup this year, despite the fact that interest rates have continued to rise across the first 5 months of the year. So is that sort of a short-term knee-jerk reaction, or is it sort of, just more telling about the property market being a pretty safe, stable asset class anyway?
Well, it certainly tells us how difficult it is to forecast the property market in the short term. You mentioned the long term there, and over time, as I said, what property will deliver for investors over time. I've got data back to the 1920s. It's got a similar long-term average annual return to show shares, which is around 11% thereabouts per annum. But you do go through rough patches. But the short term is always hard to forecast. I thought property prices would fall more. I thought we had another leg down, simply because the capacity to pay for a borrower these days is a lot less than it was in April of last year before interest rates started to rise. On our calculations, it's almost 30% less. If you've got a 20% deposit on average full-time earnings, the amount you can pay for a property is almost 30% less in terms of the amount you can borrow. So that should act as a brake. Now, the flip side is that immigrants have returned a lot faster than I would have thought would likely be the case. In the budget last year, the federal government forecast 235,000. This financial year, we're going to end up with 400,000. We've got massive shortages of property in the rental market. Rental vacancy rates on average around Australia are down around 1%, record low. And also, I think homeowners hear all of this. They hear prices have fallen, top to bottom, 14% in Sydney on the back of the CoreLogic data, 10% in the other capitals, particularly Melbourne, Brisbane, and so on. So they sort of think, what's happened in the past when prices have come down? Well, they've taken off again. And in the meantime, we've got shortages of property and we've got lots of immigrants coming in and we're not building enough new homes. So maybe that's what's driven this upswing, that people have thought, well, I better get in now, otherwise I'm going to miss out, particularly given all these issues with strong demand. But it does complicate things. I mean, we were thinking top to bottom, 15 to 20%, of which we'd done about half. There'd been another leg down. We're now thinking, well, this makes things a lot messier. Maybe we've seen it. And we revised our forecast for this year from down 7% to flat and then up next year. But the risks are still high. The positives are immigration, low vacancy rates in the rental market, lack of new supply coming into the market, and so on. But the negatives are obviously still high interest rates, the fixed rate mortgage reset, and the risk of recession or rising unemployment. So all of those things, I think, will at the very least act as a constraint in the near term. But they still mean you got to keep an eye on this. We could revert to that original scenario where prices have another leg down. It's not our base case, but that's certainly a high risk, and a lot rides on how far the RBA hikes rates and whether they tip us into recession or not. Because if they hike rates a few more times and we go into recession, it's almost assured we'll go back to the more negative scenario. So trying to forecast the property market in the short term, I think, is a very difficult exercise. If I talk to people about investing in shares, I'd say it's a time for dollar cost averaging. It's a bit hard in relation to property because it's a lumpy investment. But there are property markets out there. If I look at Perth, it looks pretty good to me because it's still only just trying to recover, just starting to recover from the slump it had post the end of the mining boom almost a decade ago. Similar story in Darwin. Adelaide, it's had a good run lately up to the top and it didn't come off as much, but it's still extremely cheap compared to other cities. Regional centres will benefit from work from home. I know work from home is trying to find the new equilibrium, but you're still going to have more desire for people to live in more affordable regional centres than big cities, partly made possible by working from home. So there are ways around it, even if you might be a little bit wary about, say, Sydney property prices or Melbourne property prices in the short term, given those interest rate risks.
And I know you come at it from the economic perspective, and I'm probably going to head a little bit too far into the demographic side of things right now, Shane, but with all those changes that we have seen from COVID, and, we did see a huge internal migration move out of those bigger cities towards more regional hotspots. Do you think we're going to be able to keep that momentum up with all those immigrants that are coming in? And as you said, work from home, working out its new equilibrium. Should that keep that moving? Is it a trend that we should just be apprehensive of in the future, or do you think it's okay to still be operating with that as the status quo?
Oh, no, I think things have changed. The pandemic, it reinforced trends that were probably already there. Like there were more people starting to work from home, but it was only a day a week for most of us. Most were still none, depending on your age and all, your preferences, but it sort of accelerated. Now we've suddenly ended up with a situation where in some offices, it's less than 2 days in 5 coming. So it's become a bit more permanent. If that's the case, then it is more viable to relocate yourself a bit further away from the capital cities, because you'd put up with 2 days a week on the train sort of thing. So I think it probably is going to be a longer term trend. I'd like to think that governments will encourage it as well. I know people in regional centres are feeling apprehensive about it because they think, well, we don't have enough houses either, and they don't. Of course, they need to be able to bring more property to their markets. They have to do that. But I think that's a far better outcome than what we had pre-pandemic, when much of regional Australia was in decline. And, I think there are ways to bring more property to market in regional Australia, because we live in a country with lots of land. There's no reason why we should be paying, I think in Sydney it's about 11 times median income to buy, is the price of a house. If you look at the demography, it comes up regularly. I know a lot of people have different views on demography, but I think they've been quite useful over the years in just highlighting the relative expensiveness of Australian property compared to, say, the US. There's many cities in the US where the house price to median income ratio is something like 3 times or 4 times, whereas many cities in Australia were 6 times or more. So we're paying double what they are relative to their incomes, and there's no logical reason for that. But it's because we've jammed ourselves into a few big capital cities and then imposed huge restrictions around that. Fair enough. I live in a nice leafy part of Sydney and I don't want units all over the place. But I think we should open up other parts of the country. I mean, I might sound like a bit of a NIMBY in that regard, but you don't want to destroy the inherent character of Australian cities by jamming lots of people in. But if we don't want to do that, then you've got to find ways to house these extra people. And regional Australia is probably one of the best ways to do that. So I think it's going to be a long-term trend. Sorry?
It comes back to that supply and demand issue that we are seeing, already. When you put too many apartments in certain suburbs, there ends up being too high of a vacancy rate and you lose that equilibrium anyway. So it is getting those people around the kind of resources and infrastructure that they need.
And you end up with social divisions. In America, you've got some cities where there's lots of high rise, just leads to social tensions and so on. So you got to find a balance. But I think bottom line is, if we're going to have high immigration levels, then we've got to find a way to manage that. And so far, I don't think we've done very well, at least from a housing perspective. We've done very well in terms of multiculturalism and so on. But from a housing perspective, we haven't managed it very well. And younger generations have a right to criticise older generations for not managing it well and creating this situation where they feel priced out of the property market. To me, it's a major failure. When I was growing up, the big failure was very high unemployment and high inflation. Now the big failure in Australia is extremely expensive housing. And I know baby boomers like myself might say, oh, well, you have it really good. You only pay 6% on your mortgage. I paid 17%. I mean, that's a completely nonsensical response. It ignores the fact that people are paying 3 times their income relative to what they were paying back then to get into property. And older Australians have benefited from immigration in the sense that it pushed up the price of houses. But I think we need to sort of look at ourselves and say, well, there must be a better way of doing this. If we're going to have this number of immigrants coming in every year, how can we better house them and more equally across Australia rather than jamming them into just a handful of cities?
Is it about then better town planning and unlocking supply? Is it mainly a government issue at this point?
Largely, but it's all levels of government. It's less federal than you think.
Yeah,
Down at the local level in the states really need to get involved here. I mean, you can fiddle with the tax system, and some aspects of the tax system are inappropriate. I think the capital gains tax discount is too generous. You hold the property for 1 year or hold an asset for more than 1 year and you pay half the capital gains tax on it. And that seems a little bit too generous to me. I'd wind that back in. Negative gearing gets more debatable. I think that if we change negative gearing, it has the problem that it's inconsistent with our tax system. And that's a standard feature of our tax system, that if you undertake investment, the cost of that investing should be able to be deducted against your income. But I do think there is a problem on the capital gains tax side. But fiddling with taxes is not going to solve the problem here. It's a bit like saying it was all due to the Chinese buyers coming in, and then we didn't have Chinese buyers for 3 years and still we had a property boom. It's really fundamental supply and demand. Number of properties you bring to new properties you bring to the market, and total demand for them, but total demographic demand as measured by immigration and natural population growth. So if we're going to have a given level of demand due to immigration and natural population growth, then we've just got to think about how do we supply. And that's where governments, I think, have been letting us down.
Shane, it has been wonderful to talk to you for the 40 minutes or so that we have had. A bit longer than I told you at the beginning, but we probably could be talking about this all day, but we bore a lot of people. So I will finish up this episode now, but thank you so much for your time, and we'll have to catch up down the track to keep exploring this, especially, in the face of a couple more rate decisions by the RBA.
Thanks for having me, Grace. It's been a pleasure. And I've greatly enjoyed the conversation.
I'm glad. I have too, and I really hope our audience has as well. If you have liked this episode, please like or review us on whatever platform that you do listen to your podcasts on. If you have any questions about this podcast or anything else that you hear on the Smart Property Investment Network, don't hesitate to reach out, editor@smartpropertyinvestment.com.au. Check us out on social media, Facebook, Twitter, and LinkedIn. And make sure you subscribe to our website for all the latest updates, smartpropertyinvestment.com.au. Until next episode, stay safe and well wherever you're listening from. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Are you looking for a new challenge that combines your existing skills with the exciting world of mortgage broking? Well, listen up, because we've got the perfect opportunity for you. Introducing the Advisors New Broker Academy 2023, a free event designed for professionals just like you who want to learn how to become a trusted broker for their clients. Coming to Brisbane, Melbourne and Sydney in June, you'll learn from industry specialists and gain crucial industry insights and intelligence to become a go-to broker. You'll also have the opportunity to network with brokers at all levels and gain a competitive edge in the marketplace. Register now for free at newbrokeracademy.com.au and join the top brokers of tomorrow.